Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. Let me share with you some updates, some of which you may be already familiar with, some of which may be new as we have developments ongoing this morning. I want to emphasize, most important thing is to remember and focus on what your long-term plan is, whether you're an investor, you're an advisor. A scenario like we're seeing today is something that is unique, unprecedented, but not something that we could not have foreseen, not in its current form, but when we are working with clients or when clients are making investments or investors are making investments, scenarios like this are factored into our thinking. So I want to get started this morning before we even talk about things that are going on in the marketplace and focus on a piece that over the weekend from American Funds, and can share this with everyone if it's something that you think would be beneficial. Over the weekend they came out with a commentary entitled 4 Ways to Stay Calm When Markets Stumble. And when speaking with clients or if you're an investor, remember that downturns are inevitable. Markets have bounced back from every crisis you can imagine in the past. And the probability, of course I can't promise you, the probability is that this time we will see a rebound as well. So to put things in perspective, when a downturn does happen of 20% or more, which is something that we have experienced this time, the average length of recovery is about 401 days, and these downturns happen approximately every 6 years. Now, we all know the reality of the fact that markets frequently come back, and historically that they have, but we as advisors have to also acknowledge our clients' feelings and their anxieties as they are speaking regarding the financial markets. We need to make sure that we keep conversations going not only in good times, but in bad times, and to keep communication simple and straightforward, not to send out 2 or 3 pages of analysis on a portfolio, but to keep things simple. When people are in a heightened emotional state, they typically can focus on very succinct and brief facts. They are not capable of absorbing lots of information. Advisors need to remind clients that when they started a relationship, when they started investing, that the journey will inevitably be bumpy. And it is important not to give in to the temptation to make sudden moves during market downturns. I was talking to Brad, he's going to speak in a little while, and Brad was emphasizing, I agree, that right now patience truly is a virtue. When you're in an emotional situation where you're feeling lots of anxiety about your money, money is a highly emotional issue. We've talked about it before. Lots of money words are emotion words: trust, bond, interest, principle, all words having to do with investments, and all words vested in emotional states. So we need to frequently revisit what was that long-term plan that we set up, what were the goals that we established. And as long as nothing has fundamentally changed, possible it has, then we need to stick with the long-term plan that the advisor and the client developed together. We have to remind the client, hey, you know, when we set this up, we talked about the fact that you had $200,000 in the bank. We had enough money for a rainy day fund. We had enough money for you cash for 12 or 18 months. Did that change? Make sure that that rainy day fund is there. If that rainy fund is there as it should be, put things in perspective. Put things into focus that you've developed a plan. The money's been set aside, and that was something we factored in when we created this plan. It was for these rainy days that we set up a rainy day fund. Well, it's raining now. But that doesn't mean that we then change the plan. The reason that we set aside the rainy day fund and earned 10 basis points, 20 basis points, 50 basis points by keeping money in short-term investments or in a checking account was for when it rains. Otherwise, we would have not set up a rainy day fund. We would have invested all the funds if the plan was when it rains to start liquidating. The plan when it starts liquidating is to go to that insurance fund and say, hey, it's there. You may not even need it, but it's there. Don't change the plan unless something fundamental has changed. Focus on putting the current events in a historical perspective. A look at history shows that while markets react to news events in the short term, they have tended to reward patient investors over the longer term. Again, the word patient. This is an opportunity to be a long-term investor, not a trader. This is where the individual investor shines. In environments like this where they can be patient, they can step in and ride out storms that many times leveraged or institutional investors cannot. Indeed, global markets have shrugged off the impact of past viral outbreaks. While the past is not predictive of the future, it does offer valuable perspective. History may not repeat itself, but it does rhyme. Just since 2000, we've had SARS, avian flu, swine flu, which was H1N1, which infected 60 million Americans. We've had MERS, we've had Ebola, we've had Zika, and that's only since 2000. And the markets, while occasionally slipping, have recovered from each of those events. And when having discussions, acknowledge the power of emotions. At the end of the day, we are all emotional beings. A key finding of behavioral economists is that people often act irrationally when making investment choices. Individuals deal with money very emotionally and viscerally. So naturally, they will expect their advisors to respond with more than just historical data, acknowledge those emotions, and remind clients of why they're feeling the way they feel. Investors need to think of, why am I feeling how I am feeling? It's because we as humans are wired to feel that we have to take action. We are wired to feel that we must react. And this is because of a few of our pre-wired dispositions. Confirmation bias, which is giving more weight to trends that you already believe in. It's easy to start extrapolating where we are with the coronavirus and to extrapolate, well, there were 10 cases, there were 1,000 cases, there'll be 10,000, there'll be 1,000,000, there'll be 1,000,000,000, there'll be 5,000,000,000. It's easy to keep extrapolating and create extreme anxiety. We also give more weight to recent events. So we tend to factor in the fact that the numbers are climbing with the coronavirus more than we give credence to the fact that there have been previous epidemics and pandemics, and they've passed. Also, there is something called framing effect, letting the presentation of information affect your interpretation of it. And there's certainly lots of social media, lots of media going on out there where we are getting all sorts of information with respect to this virus, and it's affecting our emotions. And again, this is the opportunity for professionals to shine. If a client has hired an advisor, this is the time to let the professional do the plane flying. Let the professional fly the plane, and the client can certainly be an engaged passenger, but let the client know, hey, I've got this. I'm a passenger on this plane. You've trained for this. You've done simulations. You've been through these storms before. We've got this together. So let's take a look at where we are this morning. I'll have to even check myself because things are moving so rapidly here this morning. Just taking a look at the markets. Futures remain locked down, but when you look at this from something like SPY, if you want to sort of get an idea of where the markets are going to open, if you look at SPY, because that's a stock that trades based on the S&P 500. Last I looked, SPY was trading down about 9.5%, largely erasing all the gains that we saw on Friday. So why is the market reacting so so fervently and so negatively to the events over the weekend, when in perspective of what took place, a lot of it was potentially predictable on Friday. What we see playing out this week. In fact, you can argue that we've received more positive news in the fact of action by the Federal Reserve, and we also saw some commentary by the International Monetary Fund that they will potentially free up to $1 trillion to invest to fight the coronavirus. And the analogy that I'll give with respect to the Federal Reserve is that we've got the Federal Reserve Chairman Powell, who is considered one of the greatest financial doctors, given that he's the head of the Federal Reserve. And we have the economy, which perhaps is a sick patient lying in bed. And this extremely knowledgeable, considered the top doctor of the world, walks over to the patient, looks at the patient, and suddenly decides that the medicine that the patient is getting is not nearly strong enough. He needs much stronger medicine. In fact, we're going to lower interest rates all the way down to zero. We're going to do things with quantitative easing. We're going to coordinate with central banks. We're going to cut the discount rate. We're going to lower the reserve requirements. All the things that the Fed did. And those of us who are watching the doctor and the patients are suddenly in a lot greater state of anxiety because of the actions that this expert doctor is taking while looking at the patient. We were all looking at the patient a half hour before, thinking things don't look good, but the patient will recover. And suddenly this doctor is looking at the same patient and saying, "My goodness, we need to up the medicines we got to get the bazooka of the medicine out of the medicine cabinet." And therefore, we as observers are extremely panicked by the fact that the doctor is taking these emergency measures. At the same time, the doctor is telling us, "I'm taking all these emergency measures. I'm doing all I can, but there's very little I can do, even with all these measures. I need outside help. In this case, I need help from Congress. I need help from the American people to social distance. So I'm doing all I can, but I've fired the medical bazooka, and it's not enough." And that's the reaction that we're seeing this morning. We saw this reaction, if you remember, if you go back to 2008 with the financial crisis. We saw this reaction when Congress was voting on TARP and TALF, and as things were being voted on, approved, disapproved, and then approved, the markets weren't necessarily reacting favorably. The markets were surmising, "My goodness, if we need this much help, we've got a real problem. It's a lot worse than I thought." And if we look back to 2008, with the benefit of hindsight, those were opportunities for investors. They were not opportunities to panic and cut and run. History will judge how this scenario has ultimately ends up. President Trump did send out a tweet this morning that he said text message rumors of a national quarantine are fake. There is no national lockdown. Taking a look at overseas markets, to give you an idea, Europe, the FTSE is the best performing market, down 7%. The German DAX is down 9.6%. The CAC in France is down 10.88%. The average European market down just over 8%. Probably a good harbinger of where we may be pretty close to the open here in the United States. Asia, outside of Australia, which was down 9.7%, fared better. The Hang Seng down 4%, the Nikkei down 2%. The Shanghai market was down 3.4%. Taking a look at commodities, gold down $43 this morning. Perhaps an indication of just how stressed markets are when you see gold down in an environment where interest rates slash to zero, people looking for things that are going to hold their value. Yet you see gold down this morning almost 3%, perhaps indicating that there is still leverage in the system, still required liquidations to meet margin calls, and we're seeing that in the price of gold this morning. Silver this morning, interestingly, which is not only a store of value but also a commodity that is used in industrial applications, is down 12% this morning, down to $1.73 for silver. Oil's down 8% to $28.99. down $2.74, or almost 8.5%. The dollar this morning is down significantly against the yen and down slightly against the Swiss franc, but up against the euro. Bond market, 30-year Treasury 140, that's down 16 basis points. The 10-year down 19 basis points to 76 basis points. 3-month bill 19 basis points. 2-year bill 34 basis points. We did get some news out of China. Retail sales there down about 20%. Industrial production down 13%. This is all in February. Investments in fixed assets were down 24%. Again, perhaps some insight into what we may see in terms of numbers here in the United States. Over the weekend, the House passed the coronavirus relief package to provide sick leave, unemployment benefits, free virus testing, increased food stamp benefits, small business tax relief. The Senate will likely pass a bill this week. President Trump has said he will sign it. Dr. Fauci said Americans should be prepared that they are going to have to hunker down significantly more than we as a country are doing. He said that yesterday. But he did go on to say that the worst case corona predictions will be unlikely if we do the things that we're essentially outlining right now. Treasury Secretary Mnuchin said he's going to ask Congress to reintroduce powers to scale back the 2010 Dodd-Frank legislation. That legislation limited some of the powers that had been granted to the Fed in the financial crisis, and seeking to regain some of those powers. Some of those powers having to do with making investments in individual companies, like the government did with General Motors and Fannie Mae and Freddie Mac. Some suggesting that those investments or equity contributions might be needed for some in the travel industry. In terms of polling, most Americans feel the worst is yet to come on the coronavirus, and President Trump's approval rating remains unchanged as the virus has become more serious. The White House said that they do aim to bring forward a third coronavirus relief bill, and that bill will be to help the cruise and airline industries. New York and Los Angeles have closed bars, restaurants, and movie theaters. United Airlines announced that they're going to cut their capacity by 50% for April and May. The CDC this morning recommended that for the next week, organizers, whether group or individual, cancel or postpone any events that consist of 50 people or more throughout the United States. American Airlines said they're going to reduce international capacity by 75%. Apple said that they will be closing all of their retail stores outside of Greater China until March 27th. Nike said that they will close its stores in multiple countries around the world, including the United States, to slow down the coronavirus. U.S. Department of Energy has confirmed it will purchase oil for storage in the strategic reserve. I already mentioned the actions taken by the Federal Reserve, some of which are historic, like slashing the reserve requirement ratio to 0%, cutting the discount rate to 1.5% to 25 basis points. Keep in mind, monetary policy does have an impact. It does have an effect, but it does have an effect with a lag. So it's going to take a little time for the medicine to get into the system. If we start getting fiscal help as well, these factors will start influencing the economy, but they will take some time. Former FDA Commissioner Dr. Scott Gottlieb said he thinks that we could see peak COVID-19 in late April or mid-May, saying that on a CNBC interview as we're talking. Bill Finkelstein provided me with an interesting article from, actually commentary from Bespoke Investments, the Bespoke Report, highly regarded. This report came out on Friday prior to the actions over the weekend. But I thought it was insightful at the very least. What they concluded is that, and this is on the heels of the bullish close on Friday, that the COVID-19 cases are likely to accelerate, and it's very unlikely that stocks can bottom until there is a reasonable probability of daylight for the spread of the virus. They go on to say that the acceleration in the global spread of the virus is clear. Outside of China, the disease right now is growing about 20% per day. They do point out that China, the good news is if China is the model, they have been extremely effective in containing the virus. They've had about 1,500 new cases in the month of March, which is about a 1.9% growth rate versus the 20% growth rate that we are seeing here in Western Europe and possibly in the United States. They conclude that the actions that are being taken by the CDC, the federal government, are largely in response to the lessons learned in Italy, where the system is being overloaded predominantly with immunocompromised and elderly who are all needing medical assistance at the exact same time. That is the reason for the social distancing, and they feel that that is something that is the reason that we are taking these extreme actions. They say we think it is reasonable to expect near-term stabilization in some parts of the fixed income markets that have become badly distorted. They go on to say oil, which is trading at around 30 at the time that they wrote this, that they think that there's going to be a longer period of recovery for oil, especially because jet fuel usage is going to decline significantly. And interesting, jet fuel usage comprises about 8% of all daily use for oil. There's about 100 million barrels of oil used per day, and about 8 million of that total is used for air travel. They go on to say that the massive shock to the system from COVID-19 is going to take place independent of action by the Federal Reserve. We saw that action this morning. We saw the reaction. So their analogy looks point on. They give us some other interesting facts. So the S&P 500, this is the fastest bear market decline since 1933. The S&P lost over a quarter of its value. That's as of Thursday's close in 16 trading days. If you go back and look historically when you've had such rapid declines, they point out that quick V recoveries are less common when you've had bear markets that happen over very rapid periods of time. Recoveries take longer. On February 19th, total U.S. market cap was over $35 trillion. This morning it's probably somewhere around $25 trillion. Put that into perspective. Outside of the Christmas Eve 2018 low, the last time the Russell 3000's market cap was at these levels was a few months after Election Day in 2016. So at this point in time, and now we're lower this morning, and this was written on Friday, at this point in time, the entire market cap gains seen under President Trump's election victory have been eliminated. Finally, before I turn things over to Brad, going to mention Goldman Sachs had some commentary this morning. They said that the prospect of a recovery and strong growth in the second half were dependent on whether social distancing and warmer weather reduces the number of virus cases, how quickly reduced infections will bring a return to normality, and how effective fiscal and monetary policy turns out to be. Goldman's chief equity strategist, David Kostin, said in a separate note that the S&P could fall as low as to 2,000 points if the economic of the virus worsens, but optimistically he just said he expected the index to reach 3,200 by the end of the year. Finally, a couple of stocks that Barron's mentioned could potentially be stocks that make sense in this interest rate and in this tumultuous environment. They talk about the oil refiners like Phillips 66, PSX, and Valero, VLO. Obviously, demand for their products is lower, but their spreads should be improving. Their primary input to their production is oil. So cheap oil is something that would benefit the oil refining stocks. Barron's also spoke favorably on some healthcare stocks like Merck and Amgen. Also medical supply companies like Medtronic, which is one of the ventilator makers, and Becton Dickinson, VDX, as well as UPS, as many people hunker down and and are ordering more and more online, those packages have to get delivered to those people who are ordering. And UPS mentioned in this article, not mentioned, but perhaps another beneficiary, FedEx. So we could talk all morning, obviously. I'm going to end it there and turn it over to Brad.
Anyway, good morning, anyone. Good morning, everyone who's out there. And first of all, I've been at the firm for a couple of years. I've known Keith for over 25 years personally, and I just want to say that we're so lucky to have him as our leader. He's thoughtful, he's caring, he gets in touch with you when you have a question, when you're concerned. He helps give you strength to speak to your clients, and he's never radical or extreme in any way. So we're just very lucky to have a very solid mind at running this firm. What I'm seeing here is something that we haven't seen before, and the reason what makes this so scary is that it's a combination of 9/11, because you have this incredible emotional crisis, and one side of you wants to say, don't worry about the money. The other part of this is it's 2008, because you have a liquidity crisis, and that is all about the money. So this is the first time that I've really ever seen the two together. What I do want to say, and what I've been advised my entire life to do, is when you get on a plane and they tell you to secure your mask before you secure the masks of others, that's what you need to do here. You need to be strong. You need to have your own game plan and have protection for you and your family so you can work through this, because I've seen this so many times now. I know that the opportunity is going to be great. I don't think the opportunity is going to be great today or tomorrow or maybe even this week, but I think that over time we've all seen this, and the opportunities are great. So you have to be patient. My opinion is that the government will come in and support the banks. I think that we will not have I hope that we won't have a banking crisis, and I think if we don't have a bank crisis, the banks will be able to come on in and help support these markets. I'm not saying that the markets won't drop more, but at least there should be some sort of bottoming process, and we should know it when we see it. A month ago, I told you I came in here and that I came into work after a weekend of everybody being so proud of owning stocks and being long, and I felt like I'd missed out on a lot of things, and I was very upset. And this past week, not necessarily this weekend, I started hearing a lot of people talking about how they have to sell. And a month ago, when people were buying so much, that wasn't necessarily the top of the market, but it was getting there. The more you hear people screaming, kicking, just panicking, the sharks are waiting out there. The Warren Buffett and Charlie Mungers of the world are waiting out there for this panic sale. And I could be right, I could be wrong, but if there is going to be any sort of financial world, that's what will probably play out. The timing is the question. This is uncharted territory in terms of the crisis that's going on right now. I just want to leave just that the most important thing is take care of yourself, be strong, take care of your family, get some rest, and be thoughtful the way that Keith is when he explains what his processes are. So good luck to everyone, and I'm here and I hope everybody has a good week with good health.
Thank you very much, Brad. Thank you for the kind words, and thank you for your insight. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.